Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis, and he is co-founder of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
It's a mouthful, isn't it?
It was a mouthful there for a second. I knew what I wanted to say, but it was like just kind of tripping out a little bit.
It's a lot of words in a small amount of time.
How have you been?
I'm doing awesome. Yeah, having a great time. Enjoying getting ready for college touring with my kids.
Oh,
it's
wow.
pretty cool. It's a crazy time.
Yeah, so where are they looking right now?
Gosh, the other weekend we were at back in D.C. at Georgetown. We were at University of Virginia. We're looking at Duke, and Duke's is #1. But
I was going to say, what's the top pick?
Yeah,
so Duke is #1.
Right now, Duke, yes.
All right, and are you supportive of that?
100%.
That's awesome.
Yeah.
I'm excited for you.
Yeah.
Let's talk a little bit about, obviously, the show, Stewart, if we could for a little bit, because I know that you've been so extremely busy. You've been fielding one phone call after the next. People are booking consultations with you. Tell me what types of questions they're coming in with right now.
Well, I think a lot of times people are very concerned about what they're seeing in the news. I mean, look, we've got Afghanistan, we've got this crazy market volatility going on. People are concerned about taxes. I mean, there's a lot of things out there that are really on people's minds. And I think what makes us different at Asset Preservation is the fact that we look at all of those things. And I think being a tax-oriented financial advisor, I think oftentimes, Cynthia, people are just very focused on that tax aspect, which I think is really important.
Sure, absolutely. And talking about the stock market, because we did talk about that just briefly, Stewart, obviously we've had such a strong market for so long. Let me talk to you a little bit about what happens when that begins to shift.
Yeah, so I think very likely we're at the end of this bull market. Now, technically in March of last year, we had a technical correction, so the bull market technically ended last year. But because of all the stimulus, it was such an amazing V-shaped recovery because of all the spending, the acceleration in public financing of different projects, that we saw this amazing recovery. So people see it as a continuation of the same market, which I tend to agree with. But as we near the end of this bull market, the volatility is just getting really, really crazy out there. And I think most people realize, Cynthia, that we're closer to the end of this market than we are to the beginning of it, right?
Sure, that makes
and so,
sense.
People just have flashbacks to 2008, and they say, we just don't want to lose what we had at that time. And I think it's really important to put into perspective where we are in that market. I have a graphic here that talks about where we are in the market on the S&P 500. And if you look at this graphic, what it'll show you is really how high we are. That technical correction I talked about is the last white line, that horizontal or vertical, I'm sorry, white line that is showing the corrective time. But we are at the highest point in market history right now.
Yeah.
And sometimes people remember back to 2008 or even 2000, where we saw these crazy corrections and people lost half of their life savings. And oftentimes what people don't want to do is lose half their money now because they're so much closer to retirement that making up for it is going to be really, really difficult. And when you make money and when you lose money, which we call the sequence of returns, is really important to determining whether or not you're going to have a successful retirement.
Sure. Stewart, do you feel that we could be on a brink of the recession, if you will?
Yeah, I mean, the indicators are saying that we are nearing the end of this bull market, expansion technically, and entering potential recession. But the rules have changed. I mean, I think there's a lot of things that indicate that we are in recessive times. I think public confidence is becoming a tough thing. We've seen recent numbers that are showing disapproval rating of the president in the 60s, which we've never seen in history before. Disapproval of the vice president, has never been higher since Spiro Agnew, which is, pretty nuts. I mean, we thought that there was a lot of disapproval of Trump, but now we're seeing it, I think people are just generally scared and unhappy right now. And that's when you have that kind of scariness, that uncertainty, that's when we see, unpredictable behavior in the markets.
Sure. And I think a lot of people right now are just concerned about, with everything going on in the world, how it's going to affect them specifically. Because right now you're helping a lot of people that are navigating into the retirement years. So what types of guardrails can they put up, Stewart, if you will?
Well, I think people just have to realize that where we are in an economic cycle, it's just part of the natural cycle of where, what happens in economics. So just remember, that graphic I showed you showed us at an all-time high in the stock market. I want to show you another graphic showing you where we are in the bond market. In the 10-year treasury market here, what this will show you is how interest rates have changed. Remember, historically, interest rates, I'm sorry, bonds have been very safe because interest rates have been dropping for 35 years. But if you look at the end of that graphic, look at the bottom right of that graphic there, where you see this massive dip during COVID, we are in the lowest interest rate environment in history right now. And so historically, bonds have worked really well when interest rates have fallen for 35 years.
Yeah.
But if you look at what happened in the 70s and early 80s when interest rates spiked, that's when we saw bank failures and the junk bond issues, all of the collapsing of all of those bonds. And I think that there's a lot of risk out there for assets that classically have been considered safe, like bonds. The question is, does it make sense for a 2% yield to risk that much? In the past, when yields were 17% or 15%, it's worth taking a little bond risk, right? But is it worth it at these low interest rates? And some people would just say no.
Absolutely. Let me ask you a question. What makes asset preservation tax special?
Well, I think the one thing that separates us, the very clear answer, is that we talk about taxes. And, what do they say? That imitation is the sincerest form of flattery, right?
Absolutely.
And we've started to see some of our competition talk about taxes, but ironically, they don't have tax offices built in. I think there's, I think the blessing is that we've had an impact on people, not just individuals, but businesses around us. And it's a really tough thing, but our tax office is what separates us because, I tell people that for the first decade of my career, Cynthia, I really felt like I was faking it, in hindsight. At the time, I thought I was doing the right thing. But in hindsight, when you don't look at taxes, you're missing out on half the boat here, right? It's not just about what you make, it's about what you keep. And we are in the most efficient tax window in history right now.
Yeah.
And it really makes sense to have a plan to plan around that. And what we'll do after the break is I'll talk about where we are tax-wise. We'll talk about some of the opportunities we have to correct, the issue and how to make sure that by the end of the year, we have a real plan in place.
Well, Stuart, you have a special offer to the viewers at home today. Let's talk about what that is and then open the phone lines.
Sure. Today, if you call 833-652-7829, what we're offering is a complimentary portfolio analysis. And in that review, all we're doing is offering you a second opinion of what you currently have. We'll take a look at all the fees, all the risks, and even any tax issues that we see that could be looming under the bed there. So just give us a call at 833-652-7829. We'd be glad to take a look.
Stuart, thank you so much. To the viewers at home, the phone lines are now open. That number to call is 833-652-7829. We know you have a lot of questions about how to plan for your perfect retirement. Stuart has the answers for you. All you have to do is pick up the phone and call 833-652-7829. Now, when we come back from commercial break, I'm going to ask Stuart the difference between tax planning and tax preparation. Please stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're having today. Obviously, the first segment talking a lot about taxes. Let's dive in a little bit and talk about the difference between tax planning and tax preparation, in case someone in the viewing audience is wondering what the difference would be.
Sure. Well, we do both. So tax preparation is what you do each and every year when you prepare your own taxes. You basically grab all your 1099s and W-2s and K-1s, and you just file your taxes. That's what tax preparation is. Tax planning is actually planning for future years. The problem with a lot of people is they try to get all their tax planning done in that little half-hour meeting they have with their tax preparer. And it's tough because I operate a tax office, and we did 729 tax returns this year. And if you're trying to get real planning done during those, between January and April 15th, it's a problem because those employees that are doing taxes are working 10, 12, 15-hour days, and all they're trying to do is get everything done correctly, get them out, get them filed in time. And tax planning is really important. There's a ton of different tools that we have available to us that we can use. One of which is Roth conversion.
I was going to ask you. Yeah, took the words right out of my mouth.
Yeah, that's what I do. I read minds here.
I can tell.
No, and Roth conversions, we have now. What a Roth conversion is when you take your 401k or your IRA, you decide, okay, well, I have this much room in my tax bracket left. I'm going to go ahead and pay taxes now versus later, because a lot of people, Cynthia, were told that when they were working that they would be making more money now rather than later.
Right.
Well, that was a mouthful too.
And, you got that from me.
Yes, it's contagious here. But what we found is that oftentimes people's tax brackets aren't actually dropping in retirement. And even if they remain the same, there's an argument that tax deferral is this triple compounding yield. And I make the argument against that because what oftentimes people aren't seeing is the fact that Social Security is involved. And remember, Social Security was never meant to be taxed. Social Security was designed, when FDR designed the New Deal and Social Security came out, he said Social Security would never be a revenue source for taxation. But believe it or not, Ronald Reagan was the first person to tax Social Security under his presidency in 1983. And then Bill Clinton made it way more taxable. So now up to 85% of your benefit is taxable, but that's all determined by your other taxable income in addition to 50% of your Social Security. So you add all that stuff up, and if you make more than, as an individual, $25,000 of provisional income, then 50% of Social Security is taxable. As an individual, if it's over $32,000, then 85% is taxable. So it's really easy to get to that 85% mark. And so just think about this. If you're retired, you've got all this money in this 401k, you've done an amazing job of putting the money away, but now you have to take it out. Now you need money to live on, right? So you figure, okay, well, my income is going to be lower in retirement, but now you're taking it out. And you need to live. You now need to pay taxes as you pull that money out. We all know that. But the catch is, that money now makes your Social Security taxable potentially. And for married couples, oftentimes we're seeing between $900,000 and $1.8 million of benefit over their lifetime. And sometimes that's way more than their total life savings. So this, $500,000 IRA is making their $2 million Social Security taxable. And nobody ever considers it. Nobody ever thinks it through. But that's the value of asset preservation. Judd does an amazing job at cash flowing out all of these scenarios for us. And we have CFPs on staff here. We have accountants, CPAs, enrolled agents. Listen, I don't like running a tax office during tax season. It takes up 3 or 4 months of our business. I'm working crazy hours. But the information we get is so much more than you could get by just saying, oh, we look at taxes or we look at this. The message obviously has carried on to other advisors about talking about tax and having it all in one place. But if you don't have a tax office, you really don't understand it.
Absolutely. How important is it, Stewart, for someone to have a second opinion? Because I know we've talked about this in the past. Obviously, you've had clients that have come in with tax returns that have been prepared by someone else. How often do you spend that time going through someone's tax returns for a second opinion if it's applicable?
Well, first of all, we do it with every new client that decides to bring in their tax returns. So, when people set up these complimentary portfolio reviews with us, we send out an email that basically gives a list of everything you bring. Now, some people show up with nothing, some people show up with everything. And let me just tell you, if you bring nothing, we're just chatting and you're wasting your time. Sometimes you're not wasting your time because you're figuring out, do I like this guy? Is this guy too much? Well, let me just tell you, I'm the same guy in person that I am on TV. So if you don't like me on TV, you're not going to like me in person. I'm the same person, right? I always say, go ahead and call Judd if you don't like me, right? But he's not here today, so I can pick on him a bit.
Totally, yep.
So I think it's fair game. He would do the same for me, right?
Absolutely.
But no, I think it's important to get a second opinion. What we always do is look at, what kind of things are hidden back there. For example, I had this client that he's actually a really good investor, but he had $500,000 of carry forward losses from other transactions that he had no idea about. Well, what a carry forward loss is when somebody incurs a capital loss and they can only deduct $3,000 a year against ordinary income, but they can deduct it dollar for dollar against any sort of capital gain. And so when the guy came in, he said, listen, if we're not talking about dividends, we're not talking, because that's exactly what's made me money is dividends. I said, sir, the problem with this approach is the fact that by having dividends, you're paying this income tax on those dividends.
Yeah.
If we have a growth strategy and just harvest those gains each and every year, we've got $400,000 or $500,000 of losses that we can harvest against. You're not going to pay taxes on any of these long-term gains. So what do you care if they call it a dividend or a distribution? If we can get it tax-free, why wouldn't we use it? Because those carry-forward losses aren't going to follow you when you die. So why not take advantage of it now? It's not like an asset you can pass over to your kids.
Sure, that makes sense. Well, Stewart, I know you have a special offer to the viewers at home. Let's talk about that again and then reopen the phone lines.
Absolutely. So if you call 833-652-7829, what we're offering today is a complimentary portfolio review. Now, we have offices in Tempe and the West Valley, Sun City area, as well as Scottsdale. So what we're going to do is we're going to take a look at all the risks, all the fees, any hidden expenses that are in there, as well as any sort of tax implications that might be hiding in your portfolio. But just give us a call, 833-652-7829. I'd be glad to give you a second opinion.
Stewart, thank you so much. To the viewers at home, the phone number to call is once again on your screen. That number is 833-652-7829. Now, we have to take a very short commercial break, but don't go anywhere. When we come back, I'm going to ask Stewart about pensions, so please stay tuned.
This is the story of how you get from here to there. Right now, you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, We know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're having today. And obviously with this segment, I would love to talk to you a little bit about pensions. Are they becoming a thing of the past?
Yeah, I mean, pensions really are a dinosaur, but I'll tell you what, we have some really great companies locally here, like Boeing and Honeywell, and, you know, they still have pensions in place. And the one thing that I would caution people on is, especially at Honeywell, well, first of all, it's a phenomenal company. Some of our great clients come from there. But just understand that whether they're, you know, they talk to their friends and they'll listen, hey, it makes sense to do this. Well, at Honeywell, sometimes there's 3 different pensions that exist there. So if you were hired by Allied Signal, for example, you have one option. If you were hired by another company, you have another. And so oftentimes people don't realize that their options aren't the same as their friends. So that water cooler talk of people saying, hey, you need to take it over a lifetime or take it over 5 years or 10 years. They may not have the same projections as their friend next to them. So if you work for Honeywell and you're at the edge of retirement and you have a question about whether you should take a lump sum or whether you should take a lifetime payout or a combination of both, we have all of the tools to really analyze what your options are. And we'd be glad to give you a second opinion on that.
Stewart, what are you finding most people doing today? Are they taking the lump sum option, or is it not a one-size-fits-all, if you will?
It's definitely not a one-size-fits-all, but the one thing I would say is that the limiting factor of taking a lifetime payout on a pension is the fact that you can't control the distribution once it's given to you. You know, we talked earlier about those taxable 401k distributions. That applies equally to a pension. Now, if you take a pension and assume the math makes sense for you to roll it over to an IRA, right? You can do a lump sum rollover. Now, once it's in that format, now you can actually convert it to Roth, and you can't convert it once it's being paid out to you. So you want to be in control of how that money's distributed to you, because what if you just don't need the income this year because you have enough in liquid, or you, I don't know, win the lottery, or you win some great money at one of these casinos, right? Or whatever. You just don't want to take the money this year because you've got a few $100,000 in checking that you need to burn through before taking it. Well, with a pension, you can't turn that off. You have this irrevocable income stream that's taxable, and that possibly could make your Social Security very taxable. So you just want to consider all the options before making that decision.
Stewart, what types of questions should someone be asking someone that they're interviewing to be their financial advisor?
Well, I think it's really important, first of all, to make sure that your advisor is a fiduciary. A fiduciary is the most important thing. Number 2, are they a holistic planner? And by holistic planner, I mean, do they look at your estate planning? Do they look at your taxes? Can they analyze your taxes with a CPA in-house? You want to make sure that all of those things are available. And just as importantly, do you like that person? I always tell people, never hire anyone you're not willing to fire, you know, me included. But you also have to make sure that you have a relationship with that advisor, that you're comfortable calling them. All of my clients, all my financial clients have my cell phone number. So I don't care if it's 2 a.m. in the morning on Saturday. If they have a question they need answered, I'm going to get to them. I'm going to try to get to them that day. You know, we're in crazy times right now, but I answer the phone whenever it rings. I know you've asked me to turn it off a couple of times because it rings during the show, but you know, I'm here and I'm available.
And people know that. Your clients love that about you, because we've talked about this in the past where you've been at sporting events with your family and you've had to step away to take a call from a client, and you never mind doing that.
Well, I tried when I was at one of the Phoenix Suns games during the playoffs here, and yeah, it didn't go so well because I couldn't hear a word they were saying. So we had to take it. We had to take it to text message. But no, man, I mean, if somebody puts their life savings with us, it's really important to make sure they can reach their advisor. And if people aren't getting the attention from their advisor, if they're not getting their quarterly reviews or those phone calls, you need to make sure you find somebody that is willing to work for it. Because quite honestly, you know, I jokingly say financial advisors do the least amount of work necessary to get paid. And you know why? People don't make changes. People, you know, there's a company that's kind of a friends and family marketing company where they convince these people that they're going to be great financial advisors one day. And their lead source is their friends and family. Well, guess what? Eventually you run out of friends and family, or you bug everybody too much and nobody wants to talk to you anymore because you try to sell them all a mutual fund. Well, that company, all of those clients end up rolling up to the manager once the guy goes broke and is no longer a real financial advisor. And they've sat there for 10, 15, 20 years without making a change. We see these really old loaded mutual funds that people just don't make changes with. And I think what today we're presenting to you today is that if there's a choice out there. If you think that you need help, right? If you have over $200,000 in liquid assets, of investable assets, and you want help managing that, or just want a second opinion, give us a call. We'd be glad to help.
And how often can your clients expect to hear from you, Stewart?
So what we tell people is we like to meet at least 3 times a year. Now, the beauty of our tax office is that we're going to meet for 30 to 40 minutes in tax season. But that, remember what I told you, tax season is just a review of what happened the previous year, right? But that's a nice touch to be able to talk about performance, taxes, etc. We also always like to meet in November and December, which is tax harvesting time. Because when we start talking about realizing capital gains or Roth conversions or taking big sums out of your 401k, we want to do that at the end of the year, not at the beginning, because we can never plan on those unplanned events. What if you do? We had a client that won $100,000 on a slot machine. Well, if we would have done a Roth conversion in January and she won that in February, we would have messed up the whole tax planning, right?
Yeah.
So we always wait till November, December, but we like to meet 3 or 4 times a year, but it's really up to the clients.
All right. Well, Stu, we have about 30 seconds left of the show. I can't believe how fast it goes by every time we're together. So thank you again for all of the information that you bring to the table. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We know you have a lot of questions about tax planning and how to plan for your retirement. Stewart and Judd are offering you the opportunity to come in for the complimentary consultation. All you have to do is pick up the phone and call 833-652-7829. Thank you for spending time with us again this week. Be safe, be happy, be blessed, and we'll see you soon.